What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Saturday, everybody. I hope you're all having a wonderful weekend. Let's continue from yesterday's video with more on US moves this week to better compete with China and the US-China relationship generally. Yesterday, Friday, the US House of Representatives, that is the lower house of the Congress, passed the so-called America Competes Act of 2022, a bill aimed at competing with China in technology, particularly in semiconductor manufacturing, as well as other sectors. The House bill authorizes almost $300 billion for research and development, including $45 billion over 6 years, to ease supply chain problems that have exacerbated shortages of semiconductors. Late last year, the US Senate passed its own bill. The passage of the lower house bill sets up negotiations with the Senate on a compromised version of the legislation. If both chambers of Congress pass a final version, it will go to the White House for ratification. The Biden administration has been a vocal advocate of the bill in recent months, calling the over $50 billion in support for domestic semiconductor manufacturing, quote-unquote, vital to American competitiveness. The U.S. Commerce Secretary, speaking to the press yesterday, expressed, quote, "Every day we delay, we fall further behind, and that increases our domestic national security risk," end quote. Reuters reports that House Republicans complained that Democrats did not include them in drafting the legislation. Quote, "They harshly criticized the climate provisions and said that it could be used to help Beijing, and accused Democrats of using the China measure to advance parts of Biden's economic agenda that could not pass the Senate." End quote. Climate provisions aside, the general spirit of the bill, increased support for key industries in competition with China, enjoys bipartisan support. Meanwhile, speaking of bipartisan efforts, on Thursday, a bipartisan group of U.S. lawmakers proposed matching bills in both chambers of Congress, which would require the United States to rename Taiwan's de facto embassy in Washington from the Taipei Economic and Cultural Representative Office to the Taiwan Representative Office, a provocative move which is seen as a diplomatic red flag for Beijing. Indeed, Lithuania made the same move last year, and it saw a 90% reduction in exports to China within a month. Now the EU is taking China to the WTO as the spat between the two countries deepens. Now the US would have much more sway over China than Lithuania, obviously, but the name change would still have consequences for the already poor bilateral relations between the two giants. And finally, for US-China updates today, a report from the Council for Foreign Relations published this week argues that the spread of the Omicron variant will make China's success in tackling COVID-19, quote, look more fleeting, end quote, and Beijing's, quote, opportunistic efforts to portray itself as a global health leader, end quote, may be undermined. Mr. Yan Zhonghuang, a senior fellow with the think tank, in the report argued, quote, China's efforts to seek global health leadership remain opportunistic, and its mask diplomacy and vaccine diplomacy have thus far achieved mixed and limited success. Those challenges are especially pronounced now that highly transmissible variants are challenging Beijing's draconian pandemic response and casting doubts on the efficacy rates of Chinese vaccines. China's vulnerability in maneuvering for global health leadership during the COVID-19 pandemic presents the United States an opportunity to reassert its global leadership. End quote. Now, while we're on this theme of competition between China and the US, let's touch on another important development with key US-Asian ally and the world's number 3 economy, Japan. On Thursday, Japan's Cabinet Office published a special report on trade analysis and vulnerability with its largest trading partner, the People's Republic of China. According to the report, Japan has high degrees of vulnerability to supply-side constraints in China, with more than 1,000 import items, quote-unquote, heavily dependent or higher. The special government report found that the level of reliance was about twice as much as US dependence on China. China has, quote, a more than 50% share in 1,133 categories of imported goods, or 23% of the value of Japan's imports in 2019, end quote. and that Japan's reliance on China was, quote, the most pronounced in household electronics items such as personal computers, tablets, and cell phones. Of course, anyone with a basic understanding of history understands why Japan is concerned about trade reliance, particularly on imports. This was one of the Achilles heels of the Empire of Japan in the lead up to World War II, particularly when it came to energy and other raw mineral imports. Similar to US moves this week, Japanese Prime Minister Kishida's government is expected to introduce new regulations this month to increase quote-unquote economic security and better compete economically with China, as well as reduce vulnerability to external supply-side shocks. In a research note this week, an economist at SMBC Nikko Securities Inc. expressed, quote, Kishida sees cutting reliance on China as an important theme. As supply-side crushes continue, I think Japan will be trying to restructure its production capacity among its allies, end quote. Analysts with Chinese financial media outlet Caixin observed yesterday on this report, this is on Friday, quote, while the report also showed that the overall level of reliance was little changed from a decade earlier, global supply issues during the coronavirus pandemic have added to calls for more resilient supply lines and less reliance on China. End quote. And finally, guys, let's briefly touch on a few important developments with the Evergrande crisis. Keep in mind, China has been on holiday all of this week, so not too much has happened, but there are a couple of important points that we need to cover. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. We have more information regarding the incredible Oaktree Capital Management developments, which we covered last week. We remember that Oaktree Capital began receiver moves against Evergrande's massive Project Castle asset in Hong Kong last week, as well as against assets within the mainland itself, part of Evergrande's also huge Project Venice. Hong Kong media is reporting over the last 48 hours that China Evergrande Group will continue with efforts to sell land in Hong Kong, including the Project Castle land, even after the appointment of a receiver by California-based Oaktree Management. One source speaking to the Financial Times expressed that the appointment of a receiver will not have any bearing on the group's restructuring process. This seems like wishful thinking, because if this receiver is successful in seizing these assets, then there's not much Evergrande can do, and it's going to have a tremendous effect on the restructuring process. But the person who was speaking to the Financial Times said that the asset was likely to be sold in a, quote, relative near term, end quote, and that Oaktree would be repaid after the sale was completed, and any residual proceeds would be recovered by Evergrande. Again, I think this is wishful thinking, but we'll see how this unfolds. We remember at the beginning of the week, Evergrande said in an exchange filing on the 30th of January that it was seeking legal advice in response to Oaktree's moves. If Oaktree successfully completes its seizure of these assets, even just the Hong Kong asset, but especially the one in the mainland, it would be a massive hit to Evergrande's efforts to restructure and pay back both its domestic and overseas debt. As of the filming of this, nearly $20 billion of Evergrande's international bonds are now deemed to be in default. Meanwhile, this afternoon, Saturday afternoon, China finance expert and professor at Peking University, Michael Pettis, commented on a theme within the greater Evergrande crisis, one of which we have discussed a lot in previous videos and we will continue to cover in the future. This is, of course, the indirect consequences of the property developer clampdown or crackdown, that is the impact on contractors, suppliers, goods producers and other businesses that supply the wider real estate market. This, I think, is what we need to focus on, particularly when we think about the true cost of this deleveraging campaign and how bad it could be if it is mismanaged by policymakers and other bureaucrats. Professor Pettis observed that the indirect consequences were, quote, always likely to exceed the direct consequences, end quote, and were likely to be harder to contain. Among other things, it seems that home buying interest is continuing to drop. We saw this, of course, in yesterday's episode when we looked at the collapse in sales in January, a collapse that most analysts believe will continue into February and well into quarter one of 2022. Professor Pettis quoted Goldman Sachs, quote, after improving in October and November on relaxation in bank lending, mortgage loans dipped again in December. suggesting the weakness in the property sector may be spreading from credit constraints to deteriorating household expectations and purchase demand, end quote. So basically it's saying that after this renewed push with credit, household confidence had dropped and people simply didn't want to buy houses. Professor Pettis continued by observing that for a while Beijing was able to moderate the slowdown in home prices by making financing easier, but that, quote, it might no longer work, end quote. And if so, quote, it means that Beijing will have to respond with much stronger measures, end quote. This basically means that many of these secondary or indirect consequences to Beijing's deleveraging efforts on the property development sector may end up being far more costly and much more difficult to contain and manage than Beijing economic policymakers and officials initially anticipated. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.